So we have earlier noted that in the balance sheet where we have the assets and the liabilities, deferred tax assets actually come on the asset side. Now take an example that if deferred tax asset is 500, what would this intuitively mean to us? This actually means that, say for example, if we are here today, this would mean that we must have overpaid. We have paid more to an extent of $500 prior to this day today, and that is why this will be an asset which will help me recover the benefits of higher taxes which I had paid earlier. Now how will these benefits will recoup? These benefits will get recouped over a period of next couple of years. So this benefit will be to an extent of again 500, which is our asset side. So here we have assumed that whatever we have paid more prior to this will result in some benefits, and these benefits is basically nothing but tax savings, and these tax savings will be to an extent of 500 here. Now let's take a scenario where if we assume that instead of 500 the benefits are only limited to 400, as in we now know for sure that we will not be able to recoup the benefits, recoup whatever we have paid more, and now we will be able to only recoup 400. When will this happen? When can this happen? Now think about a case where the company has paid more, and going forward, let's say in year 1, year 2, year 3 and year 4, in all of these 4 years this company is going to make losses. Okay, this is the assumption that I am looking at in a most aggressive case. If the company is reporting losses, what will be the tax liability? The tax liability will essentially come out to be zero. In fact, there would be tax credits associated with the losses. Tax credits associated with the losses would mean that you can recoup your losses in the future years by paying less taxes. So there would be an existence of tax credits, but no tax liability will get formed. Now if there is no tax liability that gets formed, how will you look at this benefit? Where will you recoup this? There will be no place where you can recoup these benefits of higher taxes which you have paid earlier. So your deferred tax assets will not be recovered fully. So what we have seen in this case is that we had paid more to an extent of 500, and the benefits that we are going to derive will be only limited to 400. So there is a difference of 100, and how do we record this on the balance sheet when we know that this is going to happen? So if we are really sure that this is going to happen and we are unable to recoup all the benefits that we are eligible for, what we'll do is on the asset side, where we have the deferred tax asset as 500, we introduce a term called valuation allowance. This valuation allowance basically reduces your deferred tax assets, and this should be reduced to an extent of the benefit which we can recoup. So this will be reduced by another 100, so that your revised deferred tax assets will be equal to 400 here. So what happens is your asset goes down by $100 here. But what happens to the liabilities side? So if we have to think about a case where assets are equal to liabilities plus shareholders equity, there needs to be some contra entry that must happen on the liabilities side. So what I'm saying is assets is equal to liabilities plus equity. What we have seen here is that assets go down by 100. So there should be some entry here on the right hand side so that this equation is balanced. So in order to match this, your total liabilities should go down. So what happens here is that this valuation allowance, which reduces your assets, is actually taken as an expense in the income statement. So in the income statement you'll find this as an expense which is called a valuation allowance expense, and this will be to an extent of $100 here. So your EBT will come down by $100, and as a result two things will happen. Your tax will come down to an extent of, let's say if this was 40% tax rate, your tax will come down by $40 and your net income would come down by another $60, so that the total amount is equal to 100 here, which is EBT. So what we'll note is that this $40 will reduce your tax liability, and this net income here will reduce your shareholders equity by another 60. So there are two things that will happen: reduction of 40 as tax liability and reduction of 60 as retained earnings. But these two will add up in order to reduce 100 overall. So assets will be equal to liabilities plus equity in this case. So this is how valuation allowances are normally treated.